We've had a crazy sell-off in many of the tech stocks, and I got a lot of questions, people asking me, what is the best buying opportunity in today's market? Prior to this video, I was saying Meta was the best opportunity, then I said Microsoft was the best opportunity, but based on today's prices, I believe Amazon is the best buying opportunity amongst the Magnificent Seven or amongst the big tech-related stocks in general. I do own Amazon. It's down 17% on the month. It's absolutely crazy. I can't believe it. Now, looking at the report, it wasn't really bad. They had a slight miss on earnings per share by about 2 cents. Nothing too crazy. They had a decent beat on revenue. Amazon Web Services has reaccelerated again, which I told you guys why it was gonna reaccelerate due to their partnership with Anthropic and then some partnerships with OpenAI. And it is massively reaccelerating from 17% to 20% to 23%. And there's many analysts, such as UBS, projecting AWS to reaccelerate to 38% growth for 2026. It would be mind-blowing, and I don't know what would happen to the stock. Maybe it will go down because everything now is going down on bad reports. But nonetheless, the report was really, really good. The advertising segment of Amazon is growing at a 32% CAGR, high margin, you could say somewhat recurring revenue business model, and it's a really amazing business for the company. Now, the reason why Amazon went down is due to their $200 billion in capex, while the analysts they were expecting $146 billion. This is a massive, massive mismatch between the reality of Amazon and the analyst expectation, over a $50 billion miss. And of course, it was gonna kill the stock. And now Amazon is spending more than any other company on capex, $200 billion. Google is spending $180 billion, Meta 125, and Microsoft at $99 billion, and it's really freaking out the market. And to me, it's really funny because the market and analysts, they're such short-term thinkers that they would rather a company do buybacks and do dividends rather than invest for the very long term and strengthen the moat, the competitive advantage, and increase the growth in general. They would prefer more short-term moves over long-term gains, which is what Amazon has always been focused on and is still focused on that. And this is why Amazon doesn't do buybacks, they don't do dividends, they just reinvest in themselves. They want to widen the moat, widen the competitive advantage, and maintain the business and increase the growth as much as possible. Now, I want to go through an exercise with you by looking at Amazon's income statement and cash flow statement. If you look at Amazon's gross profits, they're about $360 billion. They increased from 311 and 270, but 360 was for 2025 in terms of gross profits. So this is revenues minus cost of sales. You get 360 billion. Okay. Now, out of the $360 billion, Amazon is spending $108 billion on R&D or research and development. So this is whenever a company is trying to find a new product, they're trying to develop something, research something, they spend $100 billion on just research and development. And then they spent another $130 billion on CapEx. So in total, they spent $230 billion on something that's not really necessary for the business, such as CapEx and such as research and development, which went up with $7.6 billion in free cash flow. And that's why Amazon looks expensive on a free cash flow multiple. Now, I want to do a little exercise here. And I want to assume, and again, we're going to take the 2026 assumptions, which is $200 billion in CapEx, and let's assume they're going to spend another $100 billion on research and development. So they're going to spend $300 billion in 2026. Okay. Now let's assume Amazon cuts its capex by 50% overnight. They just decide they don't want to focus on the long term. They don't care much about putting up new bets and satellites in orbit and all of that. They don't want to do any of that. They just want to focus on the short term, and they want to do buybacks and dividends, maximize profitability like Pepsi and Coca-Cola. Okay? And they cut the capex by 50%. And that might sound crazy, but most of the capex of Amazon isn't really maintenance capex. The stores and the distribution network doesn't need even 150 billion in just maintenance capex. But I'm gonna assume this is a maintenance capex. So they're gonna save 150 billion. Now, if they do that, this 150 billion after some taxes will go to the bottom line. The free cash flow would jump from $7.6 billion to $150 billion in free cash flow, which would put Amazon around the 15 multiple. So Amazon right now, if it was a mature company, if it wants to be a mature company, if Amazon wants to focus on the bottom line and on the short-term stuff, Amazon would really be trading at 15 times cash flow, because a lot of this capex, a lot of this investment isn't something that's required for the business to stay alive. This is something that they can pretty much cut back on anytime. And you could look at the businesses yourself. If Amazon cuts its capex by 50%, you think people are still going to shop at Amazon, or are they going to be shopping at Wish and whatever kind of Chinese websites? Of course they're going to be shopping on Amazon. Are people going to stop going to Fresh and Whole Foods, or do those stores require more than 150 billion capex? Of course not. People are going to still go to Whole Foods. Will third-party sellers stop selling on Amazon and they're going to start selling on Etsy or Facebook or whatever? Of course they're going to be selling on Amazon if Amazon cuts its capex. If Amazon cuts its capex by 50%, will the advertising business go to zero? Will those companies stop advertising on Amazon? Of course not. That doesn't require any capex, pretty much little to no capex. How about the subscriptions? Are people going to cancel Amazon Prime because Amazon is cutting its capex? Of course not. How about AWS? AWS might slow down a little bit and it has some maintenance capex, but AWS would still be here. And Amazon would not go under. Amazon would still exist if they decide to cut their capex by 50% and focus on the short term. Yet Amazon is focused on the long term, and they want to focus on growth, focus on the business itself. And over the long term, later on, anytime they decide to, they can cut R&D and capex by 40, 50, 60, 70%. And then everyone will look at the bottom line and say, oh, Amazon is cheap. Amazon is a good company. But right now, no one is really seeing it because Amazon is focused on the long-term potential of the company. And this is why I'm a shareholder. And this is why I'm pretty much ignoring the noise and focusing on what the company does best, which is invest for the very long term. Now, looking at Amazon itself, if you're looking at AI and a lot of stocks that are being disrupted by AI, Amazon is by far the most resilient business model out of all the big seven, more than Microsoft, more than even Google, more than all these kind of names, because they have a physical moat. No one is going to disrupt Amazon's logistic network and distribution centers. You can't just make it up, code it. You can't code the distribution center, and they're about to take USPS. They have a 28% market share in parcel volume. This is a physical moat that's really not going anywhere. And something that people forget is that Amazon has an $8 billion stake in Anthropic. Now it's worth $61 billion. About 18% of Anthropic is owned by Amazon. And Anthropic is the one that's disrupting all the software-related companies. So Amazon is one of the safest stocks in terms of AI disruption. It's, you could say, immune to AI disruption, and it has a physical moat, and it has a technological moat in terms of robotics, as they're benefiting from AI, increasing margins and deploying their robotics and automation in their warehouses. So the upside over the long term from a margin expansion, from AWS, from AI in general, and even their stake in Anthropic, which Anthropic could become $1 trillion company. Amazon's stake would be worth like $200 billion, it would, which is like 10% of the current market cap. I mean, there's a lot of upside, and none of those things are priced in the stock because analysts only care about the short term and they don't care about the long term. And if I look at how much I'm paying for all of that, I'm paying about 12 times operating cash flow for a company that's growing cash flow. 29% expected for 2026, 25% expected for 2027, and 26% expected for 2028. So I'm paying pretty much half a PEG ratio, 0.6 price to, you could say, operating cash flow growth. this is really, really cheap for the company. So for me, I like Amazon. My thesis hasn't changed. I'm still a shareholder. I'm likely going to be buying the dip, especially if we go down to the 180s. This is when around my cost basis, I'm going to be buying the dip over there. And I did buy the dip before, and I own a decent stake, and I love the company, and my thesis hasn't changed, and I trust the management team, and I'm excited to be a shareholder over the next 3 to 5 years and see what happens with the company. So that was my opinion on Amazon. Thank you for watching. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.